Hi, welcome back to Economics 202, Macroeconomics. We're talking about Chapter 10, the international trade and capital flows today, looking at merchandise trade balances, something called the current account balance, analyzing those over time and in an international context, and then making sure that you understand trade balances and flows of financial capital. We'll look at nations' saving and investment identity and understand how that may lead to a rise or fall of trade deficits when we'll compare and contrast trade deficits and surpluses, and we'll talk a little bit about level of trade and trade balance. So those are two different topics. The level of trade could be high or low. The trade balance could be a negative or positive. We could have a trade deficit or a trade surplus. That's the balance. The level of trade is whether we trade a lot or a little. So let's work our way through. I just will make some comments. You can pause on these and always read about it. We talked a little bit about the hyperinflation happening in Venezuela right now in our time. Um, there's a great book that's getting a little bit dated called The Lexus and Olive Tree by Thomas Friedman. Looks at a lot of what it takes to try and build a strong economy in today's world, driven in large part by what was very true prior to uh, the US having alternative ways to get energy itself through some green energy, through some fracking technology, that has reduced our dependence on oil from other parts of the world. But Russia, Venezuela, the Middle East, major exporters of oil, and that's a key to their economies. And we were pretty dependent on them. And so there's a little bit of rundown about some of the thoughts that Thomas Friedman shares. That's a picture of him from a few years ago, just so you can put a face to the name. And it's possible that you might read that if you take international business with Dr. Barlow. So, balance of trade looks at export minus imports. Exports, what we would sell to the rest of the world, imports, what we buy from the rest of the world. The balance of trade looks at goods and services that cross national borders through that export and import. The merchandise trade balance just looks at goods, factors out services, and the current account is the balance of trade that in what we sell to others and what we buy from others in goods and services, what's called income receipts and payments. So that's money that goes out because it's been invested in some way. We'll talk about that in more detail. And what's called unilateral transfers, where I might work in one country and send money back, and I could do that as a business. I could do that as a nation. I could do that as a individual worker. And so there's a third category, unilateral transfers, that all added together give you that current account balance. So income payments refers to the money received by, if we're in the US, whatever your home country is, financial investors who have invested in foreign investments, and now we're getting money back. That could be you and me individually, it could be a retirement account, it could be a big corporation like Apple is making that investment abroad, and then as they get earnings off that investment, it comes back to the US. And then there's payments we make to foreign investors. They've bought some Apple, and it could be an individual, it could be a nation, it could be another company. Maybe Samsung has bought some ownership of Apple, invested in Apple, and when they get their investment return, that money goes back to Japan or back to that part of the world. And then unilateral transfers are payments made by governments, could be private charities and individuals in which money is sent abroad without any good or service being received. So when we make a charitable donation to help someone in an impoverished community, when you work in one place but you send that to another country to help friends and family maybe back in that part of the world. And that can be done again by government, private charities, or individuals. So at any point in time, we would have numbers for each of these categories. And some of it is money coming into the United States, some of it is money flowing out of the United States. So, this first category, things flow in. When we export goods, they send us money. When we export services, they send us money. When we invest abroad, they send income receipts and payments back. And when people working abroad send money back to the United States, those unilateral transfers come in, and then you could add those up. That's our current account balance, the side of money coming in. Then we want to understand the side of the money coming out. So when we buy goods from others, we import things, money goes out. When we use services from other parts of the world, you could use a bank that is not owned here in the US, for example, that service, then the money can go out to other parts of the world. They also have invested here, and we send some money back to them. You can, and then they'll earn money here, or that they are able to contribute somewhere else in the world. And so, whether that's our charities sending money abroad, or whether that's us personally making gifts, or whether that's someone who is from another part of the world earning here and then sending money back to loved ones, family in their home country. And so when you add that all up, you can get the difference and figure out whether we have a negative or positive current account, all those areas. So we have a negative balance of trade because we buy more goods and services. These two numbers added together would be about minus $130 billion. There's a lot of zeros not shown in this. Um, and so we buy more from the rest of the world than we sell to them. We invest more and earn more investment than we give out. Right now, unilateral transfers, there's more money going out than coming in. We do a lot to help other parts of the world, and that's a small part of our budget, but I think it's a really important part of being a good world citizen and a good model of what it means to be a Christ-like, even though our government may not use that as their motivating factor. And so our current account is negative, and that's not real time, but it gives you an idea of what it looks like over time. In fact, if you wanted to look from 1960 to 2009, so we're missing 10 years, here you can read through and again pause, read through where we had bigger and smaller deficits. I have a link here that if you click on, you'd get to go out and you could see the balance of trade in real time. I don't know why it just went to Nixon. Let's go back. And you can see what's happening with it all the way up to 2019. So that's the beauty, right, of us having internet access, is that you can quickly get real-time data that's not available in textbooks. So that's why those links are there. Please take a few minutes and just look at them. You can see how much exports of goods and services, how big a piece of the economy it is. So it's about 13.5% of the whole economy for us, where it's 45+% for Germany and almost 44% for Sweden, only 12% for Brazil. So the smaller the number is here, the less a piece of the whole economic pie that the exchange of goods and services internationally is. And then this tells us whether your current account, remember that number back here at the very bottom that looks at goods, services, investment, and unilateral transfers, whether that's positive or negative as a percentage of the total. And so the world will always add up to zero because someone's has a surplus if someone else has a deficit. And if you want to see the most current data, again, there's a nice link here to go out and do so. Remember, these diagrams help us to try and understand a story, so I'm going to just take you quickly through it. So we export, if our home country is the US, then we just call home country US, but that might not be yours. We export goods, they make payments for those goods. They send imports to us, and we make payments for those imports. Then you can come down to the bottom. We make foreign investments in other parts of the world. They give us the income, the benefit of those investments back. They make investments here in the US, and we send them the income that they've earned off of those investments. The balance of payment then, has the current account plus the capital account. When you do that, those two numbers will be zero. So since our current account is negative, if you go back and look at where we were calculating it at a point in time, and that's generally true and has been for a while for the US, then the capital account would have to be positive so that the two added together get you to zero. So a current deficit means the country's a world borrower. That's the US. A surplus would mean the country's a world lender. China would be an example of that. And I just point us to this verse: the rich rule over the poor, the one who borrows is a slave to the one who lends. And so I think that there's some wisdom for us to be thinking about how long we continue to be a world borrower. But there's a reason that people like to lend to the United States. That has allowed us, in the short term, much like buying things on your credit card allows you to live a better life today than what you earn, or taking out loans for school allows you to get the education you otherwise might not be able to afford, or the car loan to get the car you otherwise couldn't get. But that means living beyond your means now. And for reasons that really talk to our willingness to pay, our ability to pay, the safety of us as a good investment, the rest of the world has continued to invest in the United States and likes holding US dollars. So it's because we're such a trusted, good place to invest or good borrower. We do what we say, and it's safe, and there's stability in our economy and stability in our politics. Whatever you might think about this presidential election is a reason that the rest of the world's willing to invest in us. And to me, there's two types of borrowing. So if you went back to that Proverbs verse, invested well borrowing, for people, I say that's things like getting an education so you can earn tomorrow more than you can today, so you can do a job that you otherwise wouldn't be qualified to do. But in more macro sense, I mean, if we're using those borrowed dollars to build infrastructure, make sure that our people are more capable of doing work and being productive, if we invest in new plants and equipment, then that really helps the economy. R&D for new technology of the future, and that's really the United States in the 1800s. And some of what we do with what we borrow today, to be perfectly fair, we do a lot of good investing with some of the debt, and that's giving us capacity to be better tomorrow than we are today. But we also borrow sometimes, and countries do, and we consume it. That would be like you and I, wanting to take a nice trip, and it's fun for a moment, but now we're paying for it for time afterwards. Or maybe we've borrowed for a car we didn't really need, and instead of the $10,000 very reliable car, we had to go with the $27,000 new vehicle that lost $5,000 or $6,000 of value as soon as we drove it off the lot. So this can harm the economy, and there's a couple of examples in the US being more consuming with the debt that they've taken on. So generally, countries would like foreign investors is helpful for them to grow, but it can be really damaging if after putting money in, those investors get scared and quickly pull the money out. And that happened in Indonesia and Malaysia. And so generally, foreign trade makes the pie bigger, but it doesn't always guarantee that a person, a company, an industry, or a nation's slice gets bigger. That's my pie theory. So trade surplus doesn't guarantee economic growth. There's a couple of examples just mentioned in history here with well-developed countries in Japan and Germany. Trade level, that's really important that when you see trade level, you think the percent of our whole economic pie, that gross domestic product, GDP. The balance of trade is whether we sell more to others or buy more from others. And in the US, we import more, and so we buy more from others, so it's negative. But the trade level for us is fairly small. So you can see United States low trade level, but big deficits. It's a small piece, 13.5% of our total economy, versus a place like Germany or Sweden where it's 46, 45, 43% of their entire economy is trade because they're smaller countries and their trading partners are closer. Japan is an island country. It needs to do a lot of trading. So, um, but it's been advanced for a long time, and it's harder to get. I'm sorry, low trade level in Japan because it's harder to get from the island to their get products from other places, and they can produce a lot themselves. And then you have Mexico that has a high trade level, moderate trade deficit. The level of trade then is determined by several factors, but three that we'll focus on is the size of the economy. The bigger the economy, like the US, you can do more internal trading between states. The smaller the economy, the more you have to rely on trade with other countries to get the diversity of things that you would like. Geographic location matters. Are your trading partners close like they are in Europe? And do you have a history of trading where some countries have a greater history, like the Netherlands, and others more restrictive in trading, like India, in part because they were taken advantage of when they were first formed and were a colony. So your exercise for this time, I want you to go around your house, look at the clothes you're wearing, things that are in your dorm room, wherever you happen to be, and I would like you to try and find the name where they were made, and just come up with a list of as many countries as possible. So list as many things as you can find made in different countries, and let's see how big of a list of countries you can find that you own stuff from and that have been imported here to the US. Thanks, and have a great day. I'll look forward to talking to you.